All right, why don't we get started? Happy Thursday, everybody. Welcome to our market update. Thank you, everyone, for joining us. We appreciate you spending a little bit of your afternoon with us today. I'm Jeff Carbone, Managing Partner at Cornerstone Wealth, joined by my partner and Chief Investment Officer here at Cornerstone, Cliff Hodge. Cliff, thanks for on the call with us.
Yeah, thanks, Jeff. It's great to be with you. And thanks, everyone, for joining.
Well, Cliff, let me start off our agenda, just set the agenda. We're going to start out with a little bit of the overview of the shock and recovery of the markets, talk about the economy, and we'll kind of then move into where or how we're positioned and what our market outlook looks like. Just a reminder, we are recording the presentation today and will be posted to our website as well as our YouTube channel. So Ashley will get that done in the next few days. So if there's friends, family, coworkers, or someone you think would be interested in taking a listen, we certainly appreciate you passing that along or sending them to our website. Of course, just a little, if there's questions, if you go to the Q&A section in the meeting, send us any questions that you may have. We'll see if we can get to those or at least follow up with an email later on. So let's kind of jump in, Cliff. Let's kind of reflecting back over the last 3 months as I kind of think 2021 seems to, in my mind, really be flying by. I can't think it was year end or we were doing our kickoff, and now it's we're doing our first quarter review. So time is flying. If we look back and reflect on what's going on, we know it's been since March. Was the 1 year, it was about a year since the pandemic began, and life as we know it really began to change, whether it be wearing masks, the shutdown, etc. Again, we continue, our hearts go out to family and friends that we've lost. As we were reminded, and we all know, the pandemic is not over. It is still out there. Cases still continue to rise, but hopes of the vaccine, with Moderna and Pfizer especially, continue to put us maybe back to a little bit more normalcy at some point. But just do your part, wear your mask, wear it for someone else if you're not wearing it for yourself. A few weeks back, we also saw the 1.9 trillion, not billions. We don't talk billions anymore, Cliff. We talk trillions. The stimulus package passed, made its way through DC. And now we're seeing the first discussions on some tax law changes from President Biden. And they started to kick off the tax changes with a little bit of corporate tax change debate. And we're seeing some of those debates begin. President Biden as he ran, was looking for about a 28% corporate tax rate. We're seeing, again, a few folks coming back with thinking that's too high. Looking at 25, we'll see where we land. As I remind everybody, we did our session back in January. We talked about, or I spent some time talking about the potential tax law changes. Get ready. There's going to be more coming down when they happen, whether it be later this year or into next year. There'll be more debate coming. We still anticipate tax changes from change in tax rates, possible changes in capital gains, possible changes with the step up in basis upon one's death, as well as other estate tax considerations or tax law changes that will be occurring. We're also seeing, today the tone of the markets remains risk on. I think the Dow, I didn't see where the Dow finished, but it was over 34,000 for the first time. We're seeing the S&P, NASDAQ all run strong. Seeing the run of the crypto market, all these risk-on type of trades are going on. Our investment process is working, and many thanks to Cliff and the investment team. Kind of continue to work tirelessly within the process and making some adjustments in our portfolios. Behind the scenes, we're also continuing as advisors and as well as the investment team to stress test our portfolios. We see growth, and Cliff will go over today, again, the growth and inflation continuing to rise. Although we may hear from Chairman Powell or Treasury Secretary Yellen, not as concerned about inflation. We may see that a little differently from where they are right now. So it's, again, we're seeing growth in inflation continuing to move up. So it's a great time to connect and discuss your overall plan with your advisor, discuss your investment strategy, make sure we're in alignment for your risk tolerance, timeframes, and goals, etc. So Cliff, why don't we get started? Why don't you kick us off this afternoon with a little bit of a review on that, where the markets were, that recovery that we're seeing from all that's been going on right now.
Thanks, Jeff. Yeah, we've got a lot of ground to cover, not surprisingly, from a presentation that I put together. You guys know I love what I do and love to get into the weeds, so we'll do a little bit of that today. But before doing so, just wanted to quickly hit on some of the key takeaways, which I've got highlighted up on the screen here. So the economic recovery is the pace of the recovery has been nothing short of incredible, driven by unprecedented levels of both fiscal and monetary stimulus. It's actually only taken the economy about 1 year since the bottom in March to accomplish what took 6 years worth of work to do during the last cycle from 2009. So we've got some interesting data on that to share. Now that being said, the S&P and the stock markets in general are great discounting mechanisms for the future. And we think much of the good news around economic reopening has been priced in. The S&P's up now over 10 or 11% year to date. Valuation levels, as we'll see, are really stretched at the index level. However, we do think there are going to be quite a bit of opportunities still available for active managers, both in equities and in fixed income, as we'll see. Jeff hit on inflation. We just got the CPI number here earlier in the week that seems to confirm our view that inflation should continue to rise here, at least in the near and intermediate term. Massive deficits that we're piling on in order to pay for all the stimulus and the recovery actually may serve to buoy our inflationary expectations going forward, and we'll talk a little bit about that as well. We talk a lot as a team about the market signals and the warning signs. So, as we'll look and review on what we talked about during the kickoff with our quad model and the path forward. We're getting closer to the summertime lull, right? Where we think you're going to see the market begin to price in a little bit of a slowing from a growth and inflation standpoint. And then lastly, as we turn the page to the second half into 2021, a lot of uncertainty regarding President Biden's policy. So we'll kind of look at some of the potential implications of that as well. All right. So yeah, we'll start with a review of COVID-19 in the year 2020, and as Jeff mentioned, notwithstanding the just unprecedented and awful toll on humanity, we're going to be focused today on the toll from an economics perspective that the virus took on both the economy and markets. And as you'll see here in the top left, we look at output gap, which is just really the difference between what the economy is producing and its potential. And as you'll see, going back to 1950, the COVID rampage really ravaged the economy much worse than any point that we've seen in the last 50, 60 years, including even 2007, where the output gap fell to 6. We actually fell to 10%, which is pretty incredible if you think about it. The unemployment rate got north of 15% down in the depths of the crisis, and over 20% of Americans were receiving some sort of government aid. The S&P, which is the green line here, fell over 34% from peak to trough before rebounding now over 80%. The 10-year Treasury yield was north of 1.8, 1.9, closer to 2%. fell all the way down. You can't see it on the chart, but we got all the way down to about 35 basis points, which was the lowest yield on record before also rebounding in line with the equity markets as well. So, it's always good to go back and remember where we came from as we think about, where we may be heading next. So COVID, the results prompted the largest, coordinated fiscal and monetary policy expansion in history. From a GDP perspective, you can see in the U.S. over 27% of GDP has come through the fiscal channel for COVID response. That comes with a $5 trillion price tag. As Jeff mentioned earlier, we don't talk in billions anymore. Man, you look at that, that's just a lot of zeros. And not to mention what happened with the Fed and on the monetary side as well. They cut rates back to zero, started QE4, and have expanded the balance sheet by over another $3.5 trillion in just the past year alone. So this is a ton of liquidity that has been pumped into the system. And so there's really no surprise that how robust both the recovery and the market response has been. Then we look at deficits. So the 2020 deficit is going to be the highest on record, 15% of GDP. 2021 will likely be, right in line, if not worse, depending on how things shake out with the growth numbers and with the infrastructure bill yet to come. So we'll come back to the deficit here later, because there are going to be some ramifications, really predominantly centered around the U.S. dollar and the flow through of the deficits to potentially a weaker dollar. No surprise that the response has been incredible. As I mentioned on the front end, it took us 1 year to cover, if not more ground than what happened over a period of 6 years during the last cycle. So things in the economy, things in the markets are moving incredibly fast, which is okay by us as active managers, because we see the opportunities and we're certainly ready and willing to take advantage of those. So that's the story from a GDP perspective. When you look at U.S. households, they've actually never been in better shape from a financial perspective. You look at net worth as a percentage of GDP, up here over 600%. Look at personal income setting new highs, despite that the largest contraction in history. It's been fascinating. On the unemployment or the employment front as well, we did lose 22 million jobs during the COVID crisis from February to April. We've gained roughly 60% of those back already, with 13 million jobs regained since the lows. And we actually had the jobless claims number this morning came in way better than expected. So if these trends continue, we actually think the pace of the job market will continue to reaccelerate as as the vaccine takes hold, as we get right up to and through the doorstep of reopening. From an economic perspective, the data is going to continue to come in very strongly, at least over the next, probably quarter or perhaps two. Private sector salaries and wages. Now, a lot of this is a function of the transfer payments and the additional unemployment benefits, but we've eclipsed the COVID highs. You look at the manufacturing and the services sectors of the economy, both roaring back. These data points are from the ISM manufacturing and services surveys. And as you may recall, anything north of 50 is expansion, anything below 50 is contraction. In the manufacturing space, we're at levels not seen since the early 80s, 1982, 1983. And from a services perspective, I believe the peak on this chart goes all the way back to 1974. So just incredible strength and robustness in this recovery. And not surprisingly, the market, being a discounting mechanism which looks towards the future, has done an excellent job of pricing this in. And we had that 34% drawdown in the first quarter of last year, really concentrated in March. And now we've roared back. It was 78% as of the end of March. April continues to power higher, and we're now well over 80% in the recovery. And as we'll talk about in the next section, over 23% PE from a price to earnings perspective. So things are certainly getting a little frothy from a valuation perspective. But Jeff, maybe I'll kick it back to you here for a moment.
Yeah, no, Cliff, thanks for, I mean, it's just amazing the kind of the bottoms of where we were to where the recovery. But again, just showing that, again, that $5 trillion, the amount of fiscal and monetary stimulus that was thrown at getting through this pandemic, right? It's just the incredible amount of money going out there. And I know you're going to talk in a few minutes about, again, like you mentioned, what that could mean for the dollar, et cetera. I know, Cliff, I just got back from, took my first trip today, business trip. March 12th of 2020, I was up in New York when the shutdown first happened, and what a difference looking at being in right around Times Square and just trying to get out of New York to where a year later, the recovery is happening in New York. It was walking, had a fortunate to get to walk around a little bit. And people, part of it was a nice day, but people were out around NYU and Washington Square Park. It was, people were, maybe social distance was not as prevalent as I would hope it would have been, but people did take a little bit better distance, wearing masks and just trying to, but people were out. They're getting back out, right? So we're seeing those signs of recovery. So why don't you kind of take us into a little bit of the economic outlook that we're now looking for in the coming quarters?
Yeah, absolutely, and that's great to hear, Jeff. I haven't been up to New York and Manhattan in a couple of years, and I'm ready to get back. So, I'll start with a couple of slides from the kickoff. Our outlook at the beginning of the year was for 2 quarters of what we refer to as quad 2, which is where both GDP growth and inflation accelerate year over year. 2 quarters of quad 2 before giving way to a bit of a slowdown in the latter half of the year with what we refer to as quad 4, which is where both growth and inflation both decelerate simultaneously. And by and large, that has played out pretty well. We were positioned from an equity standpoint for cyclicals, high beta, areas of the market. So by cyclicals, we mean energy, financials, some of the travel and leisure stocks as well, small caps from a factor perspective. And those have all done incredibly well, really since November. It's the one area that has not performed up to our expectations so far would be emerging markets. Still positive on a year-to-date basis, but lagging a little bit. From a fixed income perspective, we said we wanted to be out of treasuries and agencies and out of duration. That has worked out well for us, as well as the Barclays Ag is down roughly 3.5–4%, which is about the equivalent of the S&P 500 for the bond market. And then lastly, we stated that we have a high conviction in alternatives for 2021, and we still continue to believe in that story, and our alternatives portfolios have been performing quite well. So as you'll see, this is going back to November 6th, where we really began to make the pivot into quad 2, that late October, early November time period. You can see the leading sectors in green: energy, airlines, cruisers, banks, so on and so forth. Industrials have all performed very well. Those were the former laggards. And then areas that were working prior, so some of the technology, some of the home improvement, online retail, so on and so forth. The big COVID winners have lagged a bit. So we've been very happy with how the thesis has played out, but we're always looking forward, always trying to be one step ahead. And so now, as we shift gears and get ready to kind of comp these easy comps in the first and second quarter, we're very interested and keenly interested in figuring out the path forward for the second half of the year. So the forecast has changed just a bit slightly. So we're still planning on having a quad 4, which again is where both growth and inflation decelerate during the third quarter. And then the fourth quarter, right, and into 2022, perhaps will largely depend on what happens with the Biden agenda. As Jeff mentioned, there's a $2.7 trillion infrastructure package on the table, which will possibly be paid for by tax hikes. So there is certainly a good bit of uncertainty going into the latter half of the year and beyond. Why the quad 4 call is important is because, as you may remember, we look back at over 30 years of market data and understanding, the expected values and expected returns of the S&P 500 by quad. And in quad 4, that's the only regime where we have a negative expected return as our starting point. And we have about a coin flip probability of making money. And so we'll talk a little bit about positioning. But when you combine the quad outlook with the fundamentals, right, from a valuation perspective, we're now over 200% of market cap to GDP. And this measure is called the Buffett rule, and we've talked and written about it before in the past, but we're now almost 4 standard deviations away from the long-term mean, which is not supposed to happen in normal markets. And at the same time, we've got some pretty massive flows chasing higher into the equity markets at these all-time highs. And so if you look back historically, chasing markets at all-time highs is certainly not been a recipe for a very positive experience. Now, that being said, we do believe strongly that there are a lot of opportunities beneath the surface for active managers that we're ready to take advantage of. So on the left-hand side here, we've got some various metrics. I'll draw your attention to the price to earnings multiples here on the S&P 500 at 23 times. But as you'll see from a sector perspective, not everything is as expensive as the S&P. And actually, when you look over, I'll call your attention over here to the right-hand side from a Z-score perspective. The way to think about this, there's a lot of data on this slide, but the key takeaway is you want to kind of think about this as a golf score, right? So anything +2 or higher is expensive and bad. Anything negative or with a smaller number is a positive, right? So some areas that we continue to like, materials, financials still are relatively cheap, energy to a degree here as well. Things that are a bit more expensive on the consumer discretionary side, the technology side, we actually still like some of those areas, but we're going to be very selective in what we're doing and really focus on quality and reducing a little bit of risk. We'll talk about that here momentarily. So then you look at the fixed income markets, and we've got treasuries, corporates. The U.S. aggregate again is the S&P 500 for the bond market. We're starting from a very low point in yields with about 1.6 on the Barclays Ag, but then high interest rate risk, right? This term is also known as duration. So if you look at the U.S. aggregate line here, a 1% rise in interest rates is going to wipe out about 4 to 5 years worth of returns here on fixed income. So it certainly pays to be active on the fixed income side as well in this kind of environment. And that really, so that's the aggregate fixed income market. Then you look at other areas like high yield, other areas like investment grade corporates. And the way to think about the spread to worst metric here is almost like a PE ratio for a stock, right? So the purple figures here are the 15-year average. The blue numbers here are the current. This is just a spread, so it's a difference in interest rates over treasuries. You actually this is the reverse of a golf score. So you want higher numbers here, right? And lower numbers mean more expensive, higher numbers mean cheap and more attractive. And really, as you can see across the fixed income landscape, a lot of things are looking pretty expensive, which is another reason why we are big fans of alternatives. And so I'm going to keep pounding the table on alternatives. So if you have not yet spoken with your advisor about some of our alternative offerings, I would certainly highly recommend it on, in your next call, in your next meeting, because as you can see, the starting point from a yield perspective is a lot more attractive than it is for fixed income. And you're really not taking on a whole lot more equity risk and a lot of equity correlation. So that's really what we're trying to do with the alts, with the alt strategy, is increase your potential return above fixed income, lower your overall risk relative to equities, and do so in a way that as a whole, when you put those three pieces together, just actually can reduce the overall risk of your portfolio and offer you a little bit better of a return, which is really kind of the holy grail of what we're after. So that's a bit of a review of where we are, where we're heading from a market perspective. I want to just take a couple of minutes here to also talk about policy before we wrap up with positioning. And so the path forward from a policy perspective, I had a little bit of fun with the headline: vaxes, taxes, infrastructure. Could all of those things lead to inflation? And we think the answer to that is a resounding yes, at least for the next couple of quarters, and then perhaps even sticking with us a bit more than what is priced into consensus. So we look at the pace of the vaccine rollout. As of right now, north of 25% of our population has received at least one dose. When you look at what's fully vaccinated versus folks that have also had the virus, this total immunity figure, we're inching closer and closer to that herd immunity range, which is really the ultimate goal to get us to be able to reopen fully and really have the economic engine firing on all cylinders. So there's a bit of dislocation, a bit of headline noise with the vaccine rollout now, especially as it relates to J&J and their shot. But from all of the information that has been made available so far, it does seem to impact only a very small subset of the population, and hopefully they can get that under control. But we still do feel really strongly about the pace and the way that the vaccine rollout is going. A lot of information here. These are all of the directives that could find their way into the infrastructure bill. So I'm not going to go through all these. These slides are going to be made available. This is from Goldman Sachs Kickoff, which got all this information from whitehouse.gov. But the total price tag on it right now is 2.7 trillion. There's that trillion word again. I'll say we don't expect most of this, or we don't expect all of this to make it into the bill. And there's a lot in here that's still very vague around, what exactly is an investment in electric vehicles. Right, there's provide funding to improve public housing. Some of these things we're going to have to get a lot more granularity, and we would anticipate that the final bill, may come in around that $1.5 to $2 trillion mark, depending on whether or not they're able to, work across the aisle with Republicans, or whether they have to go through the reconciliation process. In order to pay for that, it's going to likely require some tax reform. As Jeff mentioned on the kickoff, he would like to get the tax rate on corporate taxes up to 28% from now the 21% level, and also what's referred to as the GILTI tax on foreign earned revenues from 11% today up to 21%. And those really are more of a worst case scenario. But if that were to go through, you can see that would shave off about $17 worth of earnings per share from the S&P 500, with some sort of middle of the road number, probably closer to 197, which would be a 9% hit. Right. So if you think about the ramifications of what that could mean, either A, the price to earnings multiple would have to expand by another roughly 10%, get us over that 25, 26 number on forward earnings, which would be in line with the peak of the dot-com bubble. Or B, the price level of the S&P would have to come down by roughly 9% to keep us where we are today. So clearly, a very important item for markets and for publicly traded companies, but still a long way to go in understanding what the potential ramifications may be. The GILTI tax, you can also see, looking at the sectors, a lot of these sectors get a good bit of their revenue from outside of the US. So if they are able to essentially double this tax, a lot of the companies that are focused outside of the US, a lot of the big multinationals are going to be the ones that will be hit harder. So we're certainly going to be keeping an eye on that. And there's a throwback for the Beatles song. You may or may not have heard it before, but had a little fun with that one here as well. So we talked about all the spending leading to all the deficits, and what we have found is that historically you can see that as the deficit grows, so this side here is actually upside down so that you can see how these pairs move together. So the higher the deficit, the lower the value of the dollar has been historically, right? And so you can see that the relationship here is tracked pretty closely going back to the mid 70s on a lag, on about a 2-year lag. And so as we'll see, the deficit has blown out. This gives us a pretty high level of confidence that the dollar, making the moves in the dollar, the next big move will likely be lower, which will have a lot of ramifications on really everything, but especially in the inflation and the commodities markets. And we think the market is still undervaluing inflation. It's likely going to be a bit of a bigger deal than what is being played up right now in the headlines. So as we look, prices paid minus prices received from a lot of the Fed regional surveys. Again, this might be in the weeds a bit, but as that spread increases, CPI follows on a bit of a lag. And so, given the fact that we think the dollar is going to be going down, which will buoy commodity prices, that will likely impact the economy from an inflation standpoint as well. And more importantly, could cause the Fed to have to tighten sooner than what is currently expected. So this is the dot plot. This is what the federal, the FOMC, the Open Market Committee participants, their own forecast for what the Fed funds or interest rates are going to be going out into the future. As you can see with all the blue dots, really not much of an expectation for higher rates really until possibly 2023. But still the majority of members saying, no, nothing in 2023, perhaps 2024 or beyond before Fed funds tighten. So this is what's currently baked into the market expectations. And this is really important because if we do get persistent inflation and the economy runs really hot, it may force the Fed's hand to begin to tighten policy, first by tapering the quantitative easing, which we talked about at the beginning of the call, but then more importantly by raising interest rates. And as you may or may not be aware, almost every cycle in history or every recession in history has been preceded by a tightening Fed. So I hope you can kind of see how this is all connected and why it's really important to try and understand both the growth and the inflation picture and how that flows through really all corners of the financial markets. So Jeff, we covered a lot of ground there. I'll kick it back to you here for a moment before we wrap up with portfolio implications and positioning.
Yeah, no, thanks, Cliff. And we do realize, again, there's a lot of information that Cliff just went over, and that's why we'll send it out. That's why we replay. Just a couple things. CPI is Consumer Price Index, and that's inflation, and that's what we pay for things. I think Cliff couple acronyms you threw out there. I think you did mention the FOMC, and I think you did gave the indication of that. I did like your the Beatles, the Taxman. So do you know what Beatle actually wrote that song, Cliff? You only got a 1 in 4 chance, so you
I'll say George Harrison.
You were right. Correct. Good. Well done. Well,
I'm a classic rock fan.
there you go. Well, again, a lot of information there. You know, that's the process like that Cliff went over with the quad. Again, you know, quad 2, growth rising, inflation creeping up. Again, it shows that there's some runway in these markets, but again, things are not cheap. Not many sectors or not many positions are undervalued. Maybe they're fairly. There's definitely a lot of overvaluations we're seeing, but that's why, like Cliff mentioned, is the active management or the active approach to where going back to 2020 when it was a little bit more barbell, where you had some growth and value. So now we're a little bit heavier weighted on the growth side. There'll be a point we change again to probably undervalue or look to underweight areas that are more growth oriented as we see some slowing down. So Cliff, I'll lead us right into then kind of as we wrap up with positioning. So why don't you talk a little bit about how we're positioned and what we're watching?
Yeah, thanks, Jeff. And yeah, I'm a big classic rock guy, so that was good to have a little fun with that. But and my apologies for going into the weeds here a bit, but there's a lot happening. Things are moving so fast, but not to worry. We've got a wrap up slide that'll kind of summarize everything here at the end. But now, as I mentioned, we've really been tied to cyclical sectors of the economy for Quad 2. We started making that change back in October and November this year. And now really the main takeaway from an equity perspective is that we're beginning to shift more toward high quality. So we've started lightening up on some of our exposures in travel and leisure and high beta and small caps, depending on the portfolio and the strategy, but really taking down the overall risk level a little bit and focusing more on quality. We talk a lot about the market signals. I've listed some here down at the bottom that are grabbing our attention, but it's important to say that none of these are flashing, yellow or especially not red at this point. But some things that we have seen, a little bit of weakness out of small caps. The yield curve and treasury yields are something that we put a lot of stock in. And then lastly, I mentioned the tightening, right? So one of the Fed presidents came out recently and said that the first step is going to be hitting herd immunity. And so if that happens, by the end of the year, the markets may begin to start thinking seriously about pricing in some tightening from the Fed perspective. On fixed income, we're still going to remain, short duration, which means we're not in long term, we're not in treasuries, things like that. So we don't think the cycle for yields is done yet. And we're complementing that really with the satellite positions that are a little bit higher yielding, but not overly correlated to equities. So a bit of a barbell in fixed income. And then last but not least, again, gonna give a plug for alternatives. There are some pros and cons and things that you'll want to be aware of. So talk to your advisors about the alternative space, but we really feel good about that asset class in general. And so here's, if I was going to leave you with something, this would be, a pretty good summary of what we're doing. So some of the areas that we've crossed out were things where we were positioned for, the end of 2020 and the beginning of the year. We've made a few changes on the equity side. High beta, we're getting out of those, some of the more higher risk areas of the market. We were completely avoiding interest rate sensitivity, but now we may begin to add some of those type of exposures back in there. We're still going to maintain a position to growth and then commodities as well. Lastly, in some of the equity portfolios, we do have a little bit more cash, and we'll continue to likely raise cash as we reposition our portfolios a bit, because we are on the lookout for short-term dislocations, and we'll be ready to pivot and take advantage of those as we get the chance. And then in the alternative space, the one thing that we did add was a commodity. We pivoted out of an equity long short into a commodity long short, which adds a bit more diversification to the overall portfolio, and pairs nicely with some of the other strategies that we're using. So with that, Jeff, I will turn it back over to you, see if we have any questions, and we'll wrap up.
Yeah, I think Cliff, we got one question from Makisha. What are the main implications of interest rates rising as anticipated in the coming years?
So quite a few things for us, and kind of the way we think about it. At the kind of baseline, at the bedrock, it means that financial conditions are likely going to tighten a bit, right? So if you think about all the things in the economy that are tied to interest rates, lending is a big one. Housing is another big one, right? As mortgage rates have been at really at all-time lows for the past year, and really haven't moved up materially. If rates do keep rising, that could have a knock-on effect for housing prices, which have been on a tear here as well over the past year. I would say that's probably the biggest impact from an economic perspective. From a market perspective, it's really going to be important in the kinds of areas and factors that we want to be in, right? So in a rising rate environment, you typically want to be in things that are tied to the economy. Financials especially do well in a high and rising rate environment, and you want to be out of things that are yield sensitive. Things like low beta, things like value stocks, REITs, utilities, so on and so forth. And then there are also implications from a fixed income perspective as well. You really want to be out of things like long-term treasuries and things that are tied to duration, and into these other more satellite areas, which we currently have some exposure to now as well.
Yeah, Cliff, and just the Fed Reserve, when you hear of Chairman Powell and Jerome Powell, or the Fed minutes coming out and they talk about raising rates, the Feds control short-term rates, the market controls the longer-term rates. So just like Cliff said, the things that would be affected could be certainly the interest you earn on one's bank account, right? Now, I think if you really back out inflation, people who have a lot of money in their savings and checking accounts, well, checking usually pays nothing, but saving or money market are really losing money because the inflation factor is higher than what they're earning. So you're kind of losing money safely. So the other effect could be, like Cliff mentioned, we're certainly watching the mortgages, but credit card interest rates could go up. Car loan rates could go up. So again, those are the implications behind just the market or the fixed income or equity market. So again, thanks for that question, because that is one of the areas that I know Cliff and Sean and Bob and the investment committee that with Craig and myself and Joe and really talk about, and Liam, in really the anticipation of rising rates at some point, like Cliff said, and where do we want to be positioned, and where is our positioning taking place in the best places possible. So a lot of information as always. We appreciate your time. Cliff, thank you for putting all this together. We'll post to the website. As I mentioned earlier, we'll post it to our YouTube channel. So if you're not I don't know, this is you, Cliff, as a millennial, what do you do? Are you a follower on YouTube? I don't know. I'm not sure what the correct lingo may be for YouTube or
Subscriber.
What's that?
Subscriber.
A subscriber. Thank you. Subscribe to our YouTube channel. Certainly join us on our Facebook page. Go to our website. We appreciate all the the positive comments that we've received and emails. We appreciate the recommendations to, again, family, friends, people that need some help and want some guidance, especially in these times, because these are definitely when things get frothy and everybody in there thinks they're a financial whiz, i.e. GameStop. That's when you know things are starting to, when they turn, they're going to turn hard, and you got to be really prepared for it. So again, planning, process, and patience, right? The 3 Ps that we continue to talk about. Get with your advisor, spend some time, know where you stand, where we should be going, what do you want to do. All great time of year. Taxes, today would be tax day, but tax day is now May 17th. So if you have not prepared your taxes, you got an extra month and 2 days. But tax estimates are due today. So if you didn't get them in, get them in. Thanks everybody for your time. Appreciate the confidence, trust that you continue to place in us. As a team, it is never taken lightly, and we appreciate working hard and continuing to work for all of you. So thanks for your time today. Thanks, Cliff. Thanks, Ashley, for putting this together. We will see you at the end of the second quarter, and we'll put our Q2 together, and we will talk to you then. Have a great day, everybody. Thanks, Cliff.